You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Plenty bright, huh?
Did you pick that music?
No, I would have picked something else. Some French rock. All right. Good morning, everyone. Thanks to the OIC organization for having us and for putting this event together. Much appreciated. And thank you also for bringing this topic. I don't think historically it's been a topic that's been very much discussed, but I think it's picking up steam here, and there's indeed some interest, internationally into trading U.S. markets. So I'm excited here to have the panelists. They have a lot of experience facing clients. I want to introduce directly to my left, it's Arianne Adams. Arianne is head of derivatives and client services for the Cboe. To her left, we have Kevin McCarthy, head of financing and clearing at B of A, Bank of America. And then to his left, we've got Tanya, Patwa, head of US sales for Nasdaq. I'm particularly excited to be on the panel with the two ladies because we've been running around for years now, facing clients all around this globe. And we have a great friendship. I think the collaborative work that we've done in the past has been really fun. So I think there's a lot of insights here to talk about this topic today. And Kevin, you are my new friend as well.
Yes.
All right, so let's just dig in here. So we've heard. I want to reference the JJ panel yesterday. Of course, they were really talking about the growth of our market here, and we all lived it. We all know it. There were items that they were highlighting that were explaining that growth, such as risk protection, transparency, innovation, but also newcomers into this marketplace. So my first question is very basic: does the panel agree that there is a rise in international interest, to trade the U.S. securities here? You want to take this very briefly? We're just going to go deep into this topic. So this is there or is there not?
Yeah, I'd say there is. And I think you coined it well, Annabelle, by saying interest. I think the market is seeing interest from international participants already today in our volumes. But I'd say what we're going to talk about is also that there's increasing demand, but there might be challenges with access. In specific regions that want to continue to deploy capital into the U.S. listed options marketplace, and we're here to help and support as an industry to be able to facilitate that access or increase that access to allow more customers to be able to trade in our marketplace.
I couldn't have said it better. I think it's exactly correct. There's interest. I think that's coined correctly. We hear it all the time. We talk about the volumes and the growth. And I know we're going to break down a little bit what's behind the scene there and demystify some of that, but the focus is here. I think that the liquidity, the volatility, and the drive for the market structure does support it. And I think we're seeing a broadening of participants' interest. It's not the classic, just market maker firm or just retail. There's a lot of others out there. So we'll see that.
We'll dig into this a little bit later.
Yeah. I would certainly agree there's interest. We've seen a little bit of growth from international markets as well. What's interesting to me at least is just kind of the different participants that are interested in the markets here. So we're seeing in different regions institutional interest, whether it's coming from funds or prop trading firms, and then we're seeing a lot of growth in retail as well. One thing worth noting, which you guys probably already know, is that as an exchange, we don't know who the end client is always. We'll know who the clearing firm is or what the access point is. But with partners like Annabelle and SpiderRock and a lot of the other firms out here, it's nice to be able to collaborate and kind of learn and support that growth across the regions, actually.
Right. So, so I want to zoom a little bit on this. There's really no easy way still today to quantify how much interest is coming from overseas. Is that correct? There's no specific flags from an exchange perspective. At the bank level, on the clearing side, you guys have a better feel for it, I would think.
I mean, I'll go. I think, yeah, we have a better feel, but we're not the entire market. So we don't get all of the information that maybe others have. I think the industry, we talk about transparency, could do a better job at really publishing a bit more information around that without trying to give away proprietary information. It's somewhat difficult, but I think that the interests are growing in a way that are, as Tanya mentioned as well, not the traditional players, different funds that are looking to get into the space. When I'm in Europe, we get a lot of calls. Can you please come here? Talk to us about the options market. How does it work? What's an option? Where does it go? It's quite interesting that those that are not traditionally in the space, that have done very well, maybe in a systematic way, and have the infrastructure, have collateral, have that ability, still don't know the product in the market, and have this really satiable appetite to get in somehow.
Right, right.
Even just to further drill down on that point that Kevin makes, which is just true. On the future side, there are tags and there's an ability for us to determine whether or not where that order is originated from a jurisdictional perspective. Options, not necessarily the case at this point. We make qualitative assumptions with our 24-hour trading hours that if someone's trading around 8 p.m. U.S. time, that order might be originating out of the APAC region or vice versa earlier in the European session. So we can make assumptions where we think that order is being originated from at that given time, but quite frankly, that's not 100% accurate. But those are just some of the ways that we could determine where we think that they're seeing an increased amount of demand from a non-domestic entity.
Let's dig a little bit about into the characteristics of the clients per se, because I think there's some probably regional differences here, right? Of course, one main source of international interest is Europe. Another one is Asia, maybe some other emerging markets, right? But let's try to characterize a little bit what type of clients we're talking about coming from Europe and what type of clients is coming from Asia. Understanding there's a lot more retail activity out of Asia than there is out of Europe. Who wants to take a shot at this?
Yeah, I can. In Europe, I think we're seeing a lot more growth from institutions, and that seems to depend on the region. So we were in London a few weeks ago, and all the conversations were around dispersion trading, a lot more focus on ETFs and index and kind of whether we're listing more products or what's next for us in terms of products that we can create to support dispersion trading. Amsterdam, we've spent a little bit of time in, and it's a mini Chicago. It's all prop trading. They want to trade single stock options. And out of Asia, which we're really just starting to get to know now, we're seeing a ton of demand from retail growth. And that seems to be based on their regulatory environments. And we always refer to Asia, but there are tons of countries in Asia, a lot of different regulatory environments. And I think that's what U.S. firms are trying to navigate out there, as well as us, to kind of better understand what the regulatory landscape is and how we can support their locals being able to trade on our markets. And as somebody mentioned earlier, access is a big part of that. And it's never going to be direct on exchange. And so, again, the partners, whether we're working with banks or clearing firms or the SpiderRocks of the world, I think we're learning a lot through them and trying to figure out how we can better support that growth.
Right.
I would just add a couple of different points. I think, when we think about Asia, I think, Tanya, you've hit on a really good point. It's also about opportunity, right? And when those opportunities are closing in the region and in those markets, they look for where those opportunities are, right? People do have to have a return on capital for their investment, so you do need to generate some income somehow. So some of that drives it, but I do see it coming in through, agency type of brokers that we clear for and others, and I think that's really picking up on where the retail side is. In Europe, it's definitely more institutional. That's where a lot of the interest is. And then, you've seen those that have exited and come back in. It was mentioned yesterday that there's not a lot of new entrants, but you can hear and feel the pent-up demand. And I agree, it's not necessarily on market here. It's more remote. And then what we also see are some of the larger, proprietary trading firms or market makers, as they expand globally and they set up their regional offices globally, they are definitely accessing the markets remotely. They see the opportunities. It's different traders and different desks. And I think the point that Arianne made about extended trading hours is a good one, but it has its own complexity and problems, right? So even if you have the access, that point in time may not have enough liquidity. That point in time may have other operational concerns. And, are we really prepared without more innovation to support something on a 24/7 model, 24/5 model, whatever it may be, because the infrastructure is still not necessarily that scalable across every aspect. You need to have operations, you have a point in time, your margining, your risk, expirations, all these things have to be factored in. So that access is great, but you still have to have everything behind it to support it. So, I mean, the opportunity is great. And so for that, I'm optimistic, but I think we have to really work as an industry to support how to deal with the post-trade, not just pre-trade items. Of course, that's what I worry about.
Yeah, just to add a little bit more, because I think my colleagues, both Kevin and Tanya, hit upon Europe in a way. We're looking at it in probably 4 different regions that we see that we're really, really focused on, where we see some growth. And you can even break it down to your point on institutional and retail. It's obviously, we just hit upon Europe. And the institutional and the more professional traders and the activity that we're seeing and the interest and demand growing from that region, not only from a systematic but an institutional investor type. I'd say retail, when you're looking at Europe, is very jurisdictionally focused, jurisdictionally maybe challenged, whether there's structured products already exist and that's the way that they might access the US markets, or it's pent-up demand that needs to be tackled in terms of each jurisdiction or each country to allow for that access point to be changed or made easier for them to be able to transact in the US marketplace. And then we turn our attention, obviously, to APAC. We've already mentioned that. There's 4 regions there that we're really focused on. It's obviously Singapore and Hong Kong, but we're looking at Taiwan and Korea, where we also see a significant amount of demand, retail demand that is. And to Kevin's great point about access, and we'll talk a little bit about that next, but how can they implement these transactions? I think that there's a significant amount of interest. There's very sophisticated investors over there that like the derivative product, whether that's a future or an option. So I do think that is probably the next, probably one of the largest opportunities for this room in terms of the US listed options marketplace and growth. And if we can solve that access point, whether that's retail brokerage platforms implementing their platforms over there, or also partnering with the international platforms, or it's the broker dealers being able to handle or clear those transactions or provide access from their own systems, I think we're gonna continue to see that growth. And then 2 other regions that we're really focused on is the Middle East as well as Brazil. From a Middle East perspective, I think we're seeing a significant amount of demand, not only Tel Aviv, but Dubai, as well as Abu Dhabi. That's more, when I go down the path of institutional versus retail, that's more of a professional or institutional investor base. You're seeing hedge funds move their entities over to those regions because there's probably tax efficiencies, but there's growing demand out of that region where people want to access what we deem as one of the most liquid markets, which is US listed options. So I think that will also continue to be interesting, more so on the institutional side. And then lastly, Brazil, as we kind of talk about the 4 areas we're focused on. Again, another professional network, a professional investment community. That northbound flow will continue to grow. I know not only from a market data perspective, as I look at my colleague in the back of the room, but also from an access perspective, we're going to continue to see that product or that utilization of the U.S. listed options band grow. So lots of exciting areas where I think that we can really be focused on not just domestic, trading domestic. I think the growth is really going to come outside the U.S.
That's exciting. So we've touched a little bit on some of the points here, but I want to zoom on what are the factors contributing to this growth, right? From an international perspective, why do they like? Of course, the liquidity of our markets, right? So this is, investors around the world are chasing liquidity. It's the most liquid market, deep and liquid markets here, very appealing. But what are the other factors contributing to, to international interest coming in?
Yeah, I would say some of what we're seeing is obviously the regulatory issues and the landscape across the globe, and having in Europe especially, we think of it as, as Europe, but really each one of those regions has a different regulator. We were talking to our counterparts in the Nordics, and what I learned there was that there's 22 listing venues in Europe. There's obviously a regulatory body in each country, but there is one primary exchange in each one of those regions. And so it's really just one exchange against one regulator trying to push their agendas through. And we all, deal with our regulatory hurdles here, but there have been many instances of us, Arianne and us and our competitors banding together to kind of educate our regulatory bodies and kind of push the agenda through that we know supports the market. And I don't think that support exists in Europe, at least. And what we're learning in Asia is that each country has a regulatory body. Some are willing and wanting to govern their markets as well as access to international markets, whereas others aren't. I think Korea is one of them, South Korea is one of them at least, where the regulatory body is very stringently regulating their own markets, but access to international markets seems to be a little, they're still navigating it, let's say. And so that's where I think a lot of growth is coming from into the US markets, because of it's the liquidity, it's the transparency, it's the access points, it's trust in the financial system. One of the things that we're, as Nasdaq as a whole, is focused on is our market technology business. And while we own and operate 25 markets, we also operate another 130 markets globally, because people trust us, people trust our technology, our focus on modernizing markets to build a trusted framework. And I think that's a big part of why we're seeing growth here. And I think the other markets are looking to us, not just from a tech perspective, but a product perspective, access points, pricing schema, competition, to see if we can mimic that growth, or they can mimic that growth in those regions so that we can support international growth the way that they're supporting our growth.
I mean, they're just smaller markets, but I think that one of the points we really haven't gotten into much, and I think we should, is it's the market structure is very different, right? Not just the regulatory, as you rightly point out. It's also the fact that in the U.S. market structure, we have this one CCP, OCC for the options, and SEC. And although there's some inefficiencies with that, it still allows for us to have a unified market structure that we can fund and collateralize the right way. And in the non-U.S. markets, that's not the same opportunity, right? So you have all these pools of trapped liquidity, maybe smaller trading venues, not enough liquidity in those markets, and then it becomes even more expensive, right? And there's definitely a cost to financial resources as you have to deploy them to support the business. So everyone pushes for you to be global, everyone wants to be in every market, but if you do a very small number of transactions, it's certainly not going to pay for the investment. So it does become a tricky business from that perspective. You want to penetrate everywhere you can, but you also have to support the market structure that exists, the regulatory environment that you're talking about, and the fact that efficiencies of collateral and how you utilize those financial resources are really important in our business, and that's really what's supporting these markets as well, right? You sit in between all these structures, and you've really got to optimize where you possibly can.
I think my colleagues really nailed it. One, with access is fantastic with this business, with this asset class. Capital efficiency is huge. The ability for that to be more efficient and more effective for investors to be able to transact these large levered products. And I think the third point I'd probably hit upon is, besides this being just a phenomenal, the customers never had it better comment that Sean Feeney made on the prior panel, is the underpinnings of this marketplace. Option derives its value off the equity market. So if we look at the US equity markets, it is the bellwether globally in terms of its market structure, the efficiencies, although there's regulatory headwinds that we won't discuss right now, but that create a well-known efficient vehicle for a derivative to be traded upon. Nasdaq in New York, phenomenal places, as well as Cboe to list corporate listings, ETF listings, and that creates an underpinning and a capital and an efficiencies of a business. And those corporations or those ETFs are continuing to grow. They're very successful in their own right. People are looking to list in the US marketplaces. And because we have that underpinning with the growth that we're seeing, and then you put a derivative on top of that, that continues to make a phenomenal ecosystem. We have an ecosystem that you have not only a phenomenal options, we continue to list more and more options contracts, but we also have a very robust IPO and corporate listing schedule. So that creates a very unique market structure that has no better, place for people to invest their money alternatively or traditionally, and that allows us to be very, very profitable in terms of what we're seeing, and that's why the growth is continuing to be realized in the U.S. marketplace.
If there's one thing we could do better, right, to really sort of make this happen, or just hockey stick growth, right, from the international scene, what would it be? Is there one thing that we could do better?
I would say maybe not better, but more of is education. The number one ask that we get from our counterparts globally is like, can you come in and talk to some of the largest firms in other regions about your market structure? And I'm always, it's always impressive that they're asking these questions, but I'm always amazed at the questions that they're asking about just very basic elements of market structure, like what are your market models? Why are there 16 exchanges? And so I think what we can, as exchanges especially, like what we could and should continue to do is just educate people, not just on, obviously our index products or certain elements of our, just really a like 101 and continuing to educate them, right? Not just going in there and like, here's options 101, but addressing those questions and using our global reach. And we're focused on educating our sales force across our regions to better understand it, because sometimes it's just about them being able to identify opportunities. So I would say deeper education and with the more global reach.
I think with a levered product, there still remains capital inefficiencies. There's capital inefficiencies for customers, whether that's institutional, retail. There's capital inefficiencies for our liquidity providers that I think is hamstringing or will continue to hamstring the growth in the industry. As we think about customer portfolio margining and the OCC's work that they're doing to enhance their risk metrics, and the ability for us to continue to advocate for, one, to Tanya's point, that the regulators understand these products, they're levered products, however, there's the right protocol risk controls in place, that there should be more effective ways for us to receive offsets when you're overriding stock position with a call option. Those types of things can make an investment portfolio and reduce the capital requirements attributed to those positions and allow for more deployment of capital. So the ongoing advocacies of all of us and everyone in this room is critical in one area where I think we can be doing a better job to be able to continue to see this growth and actually materialize it, to your point, up and to the right, to that hockey stick, because I think there's a lot of work to be done there.
Agreed.
Yeah, I think when we talk about capital efficiency, there's a couple of things. I think one is operationally, we need better fluency, better support, better innovation, because we're still doing things in somewhat of a legacy way in a constantly growing environment. And if people want more and more real time, you can do real time risk, but it is a lot to manage the expiration process. As we increase frequency, not everything is fully automated, and you have to make sure that you don't expose more risks, right? So if I could talk for a second about, we talk about different participants in the marketplace, right? There are 3 designations at OCC. I'm sure most people know this: firm and customer and market maker. They're not fungible, right? And so what happens is when you as a clearing firm or a member are posting your collateral, you have to make sure that it's for those separate designations. And so that also tends to lock up some ability to have, capital efficiencies. And when you look at that as well, customer designation has more risk than the market maker designation for a lot of reasons as well. So, when we see more hedge funds coming into the space, which is great, right? They're not, back to the education point, always understanding the complexities beyond the execution and the post-trade, the exposure with expirations, the exposure with operational risk, and then actually the limitations from a funding and a financing resource perspective, right? We know years ago, we a lot of people in this industry focused on the inefficiencies of RWA and capital with CEM, and fortunately for the market makers, SACR came along and alleviated some of that. But RWA is still a constraint, right? So it's not just a capital, direct collateralization perspective. If you're under collateralized, you have to post cash, you have to do other things. And then you also have the considerations of RWA. They can be managed, right? But this is where I think there's an opportunity still for better efficiencies and better understanding, better transparency, and working together as an industry to really solve some of these actually big macro problems that I think are based on a very old, legacy structure. And I can say that because I've been doing it a long time. It hasn't changed much, but I think that this is where we really do have actually better opportunities to grow. Okay. It's not just volume for volume. There's notionals are higher, balances are higher, requirements are higher, and then you still have other capital inefficiencies.
Yeah. I mean, from a platform perspective, I was running around London last week, and it's fascinating to see how they all, first of all, they don't understand the tools that they could leverage, right? And once they start understanding the tools that they could leverage, then there's always this big ha-ha moment where, oh, you mean that we can actually put that dispersion trade and, just, trade on your markets efficiently? Yes, you can. But then, it just goes back. So it goes back to education. It goes back also to your point. What I see that still prevents them from really ramping up is operational for the most part and compliance. And that takes months, if not a year, to go through these barriers, with clients, particularly in Europe.
And we have T1 coming in, right? And hopefully we see that has other benefits to lock up less collateral and better efficiencies. But think of the impact it has to the industry to focus on that, to develop what we need to develop. There was concerns around the timing of it. The entire industry has to make sure that works seamlessly together, right? Yeah. If you're doing that, you may not be able to focus on other innovations. So there are also conflicts that we have across the market structure where we're trying to refine, and they're good, well-intended design changes and better for the overall climate of the industry. But again, they are impactful to how much resource you are constrained by or the time and attention you can give to other efficiencies that we could have.
I want to shift gear a little bit here, and we've sort of highlighted what our expertise, is in the U.S., right? How do we export this expertise internationally? So now we're just looking at the reverse, right? I mean, how do we identify opportunities from an exchange perspective? I'll start with you, Arianne. How do you identify these opportunities to actually just grow and export, this market structure, central clearing, and all the things that we do well in the U.S. elsewhere?
Yeah, well, you take this model that we have, wonderful market structure, wonderful underpinnings, all the comments we just went through with you, Annabelle, about why this market is robust and ripe to continue to grow. And then you take your eyesight and you say, hey, listen, where are there areas where there's fragmentation, maybe there's lack of competitive, or competition to really have the ecosystem for a customer to be able to execute a derivatives product. And I turn my eyes to Europe or even Canada to say, hey, listen, maybe in Europe, you have fragmented marketplace, you have multiple access points, you have multiple exchanges, multiple products, multiple clearing entities, multiple market data centers, and cost, and inefficiencies of trading. And then you compare it to what you have in the US, lots of exchange leaders, lots of exchanges, one centralized clearing, and you think to yourself, those are those scream opportunities, especially when you have the customers calling, like you were just saying, hey, listen, how can you make this easier for us to access? Obviously, Cboe's going down the path with SEDEX, which is our European derivatives initiative, and creating that one access point, one clearing entity, one data access points, to be able to make that more efficient while implementing U.S. market structure that we continue to hone. Those are, I'll be perfectly honest, it's not easy. It's very hard actually to do that or go against head-to-head to a competitor. But I think what we've learned in the US in this market model and the growth that we're seeing and continuing to see makes sense for us maybe to implement these in other regions, because what we continue to see is people are demanding that type of market structure, whether that's electronic voice, cap commit, to be deployed in other areas. And I think with the brain powers in these rooms and in these industries, I think that we can all collaborate to make that happen. And that's what we've started to do in Europe. And there are other regions where that is viable. It's just making sure that we can have not only the members, broker-dealers, the access points, and the willingness and the operational and the clearing entities to be able to do that collectively, to be able to unleash some very powerful amount of assets to be deployed in multiple different regions, in addition to what we're seeing in the States.
So yeah, you have a...
I was just going to add real quick. I mean, I think, we've seen consolidation happen because when you're thinking about the global markets, you need to have that breadth, that capacity, that scale. And so if you're a smaller clearing firm, right, in one particular market or other, it's just very inefficient, right? Global clients need to have a portfolio view, a risk management that's more global to the extent that it can be. I mean, obviously we're bound by regulatory and other components, but where there's efficiencies that they can have. And so what we've seen is smaller players not have that access, where we have come in and some of our competitors have come in to be able to provide that opportunity as well. And I think the education, which was back to the original point, is really been, it's client demand. I mean, clients are really demanding this a lot. And I see it all the time. We talk about Brazil, you talk about Canada, every single market, there's an opportunity to educate, but there's serious, boundaries that we can't get over or restrictions that we have to get through. So I think the education is also about where those challenges are. And so I agree with what Tanya said earlier as well, the exchanges and the entire industry can do a better job at educating overall, and maybe we need to do, a white paper or something else that may give a little bit more color and insight about where those opportunities are.
So from a global bank perspective, your value add is really, better margining, right?
To the extent that we can, yeah. I think it's looking at collateral. I mean, you have certain restrictions. I won't get through all of that, but whether it's your legal entity structure or cross-border considerations, but from a perspective from our side, we look at a portfolio, right? We're not looking at options as a discrete product in the US and a sub-account, right? We're looking at a portfolio-based business, and to the extent that clients are organized in a way that we can do so, or there's perfected security interest and other items, we can look across that and give benefits. So maybe there's not cash moving all around the globe. Maybe there's offsets that we can provide. Those are things that add just a bit more efficiency to those global type of organizations and make a difference to that access point, and hopefully remove some of those costs that we're talking about. It reduces some of the costs to the end participant in a way that helps them grow, right? We want people to be able to get in. We want people to get in and trade. We want people to be able to have liquidity. That's good for us and the industry. So overall, that's what we're trying to do, is really provide that capital efficiency, cross capabilities wherever we possibly can, and if the more access, and also diversification. The more diversification we have in a portfolio, obviously the better the risk profile is. So for us, we want to inspire that ability, right?
Makes sense. Tanya, anything?
Yeah, I would say in terms of the exchanges that we own and operate, we own and operate some of the Nordic markets. So we are now working a lot more closely with them to just not only understand how their markets work, but educate our teams internally about, not even just educate, just have discussions around like their market structure versus ours and what we can borrow from them and vice versa. Borrowing more from us, I think, than the other way around, but just helping them understand kind of what's working here and what's not in terms of transparency, in terms of data, and trying to see where we can find synergies there. One of the bigger initiatives at Nasdaq over the last couple of years has been migrating the exchanges that we own and operate onto one harmonized technology. And so obviously technology in and of itself isn't going to breed liquidity. We're trying to solve for a liquidity problem, but having one framework to work off of, one technology that when there's innovation on our platform, it kind of spans both of our regions, is something that's a big focus of ours. And so with the 25 markets that we own and operate globally, we are looking to move in a direction where we have one platform. So for firms here, when you want to connect to our exchanges in the US, you've really already done the work to connect to them in the Nordic markets. And on our end, we can innovate more efficiently, I would say, across those regions. And then that same framework is what the other 130 exchanges will use at some point. And a big part of that is the partnership that we announced with AWS to kind of just be a little bit more nimble there. And we spent a lot of time deciding who our partner would be. AWS was the obvious choice for us, and we're now able to innovate with them and hopefully spread that innovation globally over time.
Okay. I mean, from a platform perspective, I think cost, for us, we have, and we're tiny compared to these guys, right? But we have a role to play in providing access, right? And the cost is staggering, for us to actually just do what we do in the US and to export this expertise elsewhere, right, the cost is staggering. So having pan-European cash as well as pan-European derivatives exchange, where you can hedge, very easily using just one market and not, a fragmentation of, 20 and some exchanges is key, right? The issue that I see a little bit here, this chicken and an egg question with liquidity, right? How do you've got established exchanges in Europe, you've got established exchanges in Asia. You're going to have to just start building this liquidity on your pan-Asian or pan-European exchanges, and that's a real challenge. So what are the hurdles in doing this? I mean, is there something that you can pinpoint in just trying to prime that pump, right? What needs to happen here?
I think you're hitting on a great point on the liquidity provider side. I'm watching, our largest members and their largest members globally. They're trying to address it as we're trying to address it as exchange operators on how and where they can expand globally. And they want an efficient marketplace to be able to deploy capital to make great markets, right? If whether or not they're expanding in APAC or in Sydney or in Europe or in the Middle East, they're all areas there where we're all trying to enhance the ecosystem. So I think doing it collaboratively is a critical part, and that's how, as exchange operators, we want to be aligned with our members and our largest liquidity providers as they continue to want to deploy capital on inefficient market structures. So we're watching that trend happen and participating alongside of them. I would say it's an opportunity, Annabelle, and one that you nailed, but it's one that we're going to continue to have to work on, especially the market structure and the jurisdictional restrictions to kind of make markets more efficient outside of the U.S.
Okay. Anybody else? We're running out of time, unfortunately.
No zero DT question?
No.
It's the only panel.
You want to?
No,
go for it.
Right.
I mean, we can go into this. The problem is that it's taking 0, 0, 0.
Yeah. We'll pass on that one.
More is not always more.
Yeah.
All right.
Everyone's already covered it.
Un grand merci à vous, les panélistes. Maintenant, on est vraiment international. Je vous remercie beaucoup. Thank you so much for the panels, for addressing the international interest. A lot of my clients are French these days. They're all coming out of the quant. It's wonderful. I love it. Anyways, thank you very much. Thanks to the panelists.
Thank you.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.